Start streaming. Wow. Why is this one doing that way? Okay, good morning. Today is June 20th, and what we are going to do is finish chapter 10 by doing some examples on depreciation, and then we will go back to chapter 8, 9, and 10 also to do some. Today is June 20th, and what we are going to do is finish chapter 10 by doing some examples on depreciation, and then we will go back to chapter 8, 9, and 10 also to do some. I think this one might be enough. Can you come here for just a second, talk, and let me go and listen?
All right.
See if that's it. Just say anything. For a second. Keep saying, go.
Today we're gonna be talking about chapter 8, 9, and 10. We're gonna go more in detail with a little practice work here in account 1. Today is June 20th, 2018. My name is Dr. Grimm, and I'll be teaching you today. Turn to page blah blah blah.
Let's do it. It's okay.
Oh, all right.
What you say?
Well, now we was checking the mic.
Thank you. It's okay.
You good?
Yeah. Now you can hear it easily there. Yeah. This one is making the trouble now. Okay, so we're going to talk about depreciation methods. So open your book, page 375, where it talks about methods of computing depreciation. So I'm going to go to Excel to give examples, so the others can see us.
You said 375?
Yes, sir. Methods of depreciation. Okay. The first method of depreciation is the straight line method. All right. The first method is straight line. Straight line method. All right. This method is an easy method. And depreciation is equal to, okay, depreciation expense. Depreciation expense is equal to the cost of the asset. Okay, is equal to the cost of the assets minus accumulated depreciation, minus accumulated, oh sorry, I'll take it back here, minus residual value. Yeah, minus residual value divided by the life of the assets, divided by the life of the asset, and the life can be in years or units. All right, life can be, and so I put between two brackets, could be years or units. All right. So let's look at this example on the next page. On the next page, page 376, You see the example on the top of the page? It says a delivery truck costs $20,000 and has an estimated residual value of $2,000 at the end of its estimated useful life of 5 years. So the residual value is 2,000. The life is 5 years. Under the straight line method, the annual depreciation would be what? So so let's use straight line method, and we use this formula. Okay, so straight line, under straight line method. Okay, the cost is what?
$20,000.
So we're going to say $20,000 minus residual value is
2,000.
minus 2,000, and if you divide it by how many years?
5 years.
By 5 years, what do we get?
3,600.
How much?
3,600.
20,000 minus 2,000, 18,000. Divide by 5, 18,000.
3,600.
All right, equal 3,600 per year. Okay, depreciation per year. Now, okay, at the end of, if you take year 1, for example, at the end of year 1, okay, so 3,600 has been depreciated. So what is the book value of the truck at the end of year 1?
The book value is going to be, let me check. You're going to do 20,000 minus 36.
Or the carrying value. Book value or carrying value at the end of year 1.
Yeah, so you're going to do 20,000 minus 3,600.
Uh-huh.
16,400.
Yes, sir. All right, and then, so this is year 1.
Oh, it's right here too.
This is first year. All right. Now on the second year, since this is a straight line depreciation, every year is the same. So on year 2, second year, what is the carrying value?
12,800.
How did you figure that out?
Because you're going to take another 3,600
Yes.
away from
Uh-huh.
16,000.
Also, okay, tell me, what is the accumulated depreciation at the end of year 2?
7,200 because you're going to add 3,600. Well,
All right.
multiply it by 2.
Okay, so second year depreciation is equal to 3,600 again, 3,600, and book value is, or carrying value, book value or carrying value is equal to at the end of year 2 is going to be 12,800, and that represents 20,000 minus 36 minus 36. Okay, so you keep going down, the carrying value keeps going down until what amount?
Till 2,000 or until the 5th year, basically.
But you can't go below 2,000 until the carrying value is 2,000. Okay, when the carrying value is 2,000, that's the end of this, the life of this truck. Yeah.
Truck only lasted 5 years. That's
See, if let's assume, if you assume that year 4, look at exhibit 4. If year 4 depreciation is
14.
let's say it's 4,000.
The
Oh
annual-
no, let me take it back. If year 3 is 4,000 depreciation, yeah, the annual, assume,
Oh,
okay, 4,000. So you're going to take the 4,000 out of 12,800, correct? And that will leave you how much?
8,800.
Okay, 8,800. No, let's assume year 4 is 4,000. Year 4.
Oh,
Sorry. Year 4 is 4,000. You're going to take that out of the 9,000. No. Yeah, out of 9,200, what do you get?
You get, I want to say, how many do the math?
9,200 minus 4,000, it's fast.
5,200. Yeah.
5,400,
No,
correct?
5,200.
5,200.
Yes, sir.
So, out of the 5,200, you cannot do, if you take 3,600, how much would it be?
It'll be below 2,000.
Below, then you cannot do it. So only you can take
So,
between 5,200 and 2,000. So it's not 3,600, yeah. So the last year usually is going to be the amount that gets you to the residual value, 2,000, yeah. All right. So this is the straight line method. Okay. Now the production method is the same formula, except the denominator is going to be not 5 years, it's going to be in units. So under the production method, okay, under the production PR method, PR for production method. All right. Okay, depreciation expense is equal to depreciation expense is equal to the same thing. The numerator is the same. Cost minus, cost minus residual value divided by
Life for assets.
units. In this case, is going to be estimated life in units, or units of the life of the assets. Units of the life of the assets. So in this case, the cost is the same thing, which is $20,000, correct?
yes, sir.
20,000 minus the residual value, which is still 2,000. 2,000. Now the question is, how much is how much? In this case, is in the mileage. The life of the truck is in the mileage. So what is the life of the truck in terms of mileage?
90,000 miles.
Where did you find that out?
It's in the notes. Because it's right under the straight line method. It goes talking to the production method. It gives you the formula there at the example. It says, assume that the delivery truck in the previous example has an estimated useful life of 90,000 miles.
Okay, so we divide that by 90, 1, 2, 3. So how much is that?
20 cents per mile.
20 cents per mile. All right, that's equal to 20. And so let me put the cents. Now, how do you put the cents in just see? I'll just say, write it down. 20 cents per mile. All right, 20 cents per mile. I think it's like this. Okay, if I were to write it down, I think it's like this per mile. Yeah. So if it depreciates 20 cents per mile, okay, if the truck is driven for 20,000 miles the first year, okay, so if the truck is driven 20,000 miles the first year, so how much is the depreciation for the first year? It's going to be 20,000 times 20 cents. 20,000 miles times 20 cents. And that's equal to $4,000. So depreciation for the first year is $4,000. So, what is the book value of this truck at the end of year 1?
16,000.
16,000. All right. Let's assume the truck is driven for 30,000 miles. I'm not going to follow the Exhibit 5, okay? So I'm going to assume if the truck is driven 30,000 miles the second year. So how much is the depreciation for the second year? It's going to be 30,000
6,000.
times 20 cents. So that's equal to $6,000.
No, that's 6,000 miles.
No, $6,000.
Oh, yeah.
20 cents
30.
per mile. Yeah. It driven 30,000 miles. Okay, so what is the book value of the truck at the end of year 2?
10,000.
20,000 minus 4 the first year, so that's 16 minus 6,
Make it $10,000.
$10,000. Yeah. So that's how the straight line the production method looks like. Yeah. Okay. All right. Then we're going to move to the third method is the declining balance method. Now you remember what the declining balance method is about? Don't look in there. From yesterday. That's the accelerated method. That's when the asset has been used heavily in its first years of its life. It used a lot the first couple of years. And we said, I remember we gave example electronics. They are used heavily, like these cell phones. You know, they are used heavily at the first year, second year, and then...
That's why they make a new phone every
Yes. All right, so the best method for depreciating this equipment is using the declining balance. And then the declining balance, it could be double declining or triple declining. Okay, so how does that work? Here is how it works. The declining balance. Don't look in the book. Listen to me. You take the whole life of the asset, 100% of the life of the asset, and you divide it by the years. Okay, so you take the declining balance. Let me write that declining balance. Okay, you take the whole life of the asset, which is 100%, correct? Whole life of the asset, or 100% of the life, and you divide it by the life of the asset. You divide it by the life of the asset. Okay? In this case, we're going to say the 100% of the life of the asset, 100% or 1. Bless you. 100% or 1 is the same, correct? 100% is 100 over 100 equal 1. And you divide it by the life of the asset. In this case,
say 5 years.
okay, 100% divided by 5. And that's equal to 20%, correct? Is equal to 0.20 or 20%. And then, okay, if we're saying double declining, if we use the double, then we say 20%,
Times 2.
20% times 2. If it is double declining, times 2, in this case is equal to 40%, correct? 40%. So the depreciation in the first year is 40% of the life of the asset. So this truck cost what? $20,000, correct? If we are using double declining, so the first year is going to be 40%, 40% times
20,000.
20,000. And that's equal
8,000.
$8,000. So the depreciation for the first year of this truck is $8,000. All right. Now here we don't say, be careful, we don't say cost minus residual value. Forget about the residual value. You go do straightforward. Double the percentage times the life, the cost of the asset. So what is the book value at the end of year 1?
12,000.
All right, so the book value is equal to 20,000 minus 8,000, and that gives us 12,000. All right, $12,000. All right, so the next year is going to go down by also $8,000. So 20,000, 12,000 minus 8 is
What did you say? I'm sorry.
the next year depreciation is still $8,000. Okay, so the book value is going to be 12,000 minus 8,000. See, we didn't say 20,000 minus. I was just saying 20,000 minus.
You're talking about the double depreciation, right?
Yeah, double declining.
Double decline. So when we times 40% by 12,000,
By 12, yes, sir.
20% times
Yeah.
12,000, that's 48.
Oh, yes, sir. Yeah, thank you for that. Appreciate you. Thank you. We say 12,000 times 40%. Yeah. 12. Thank you for the note. Times the 20%. 40, sorry. 40, and that gives us
4,800.
4,800. Okay, so the book value at the end of year 2 is 12,000 minus 4,800, and that gives us.
7,200.
So the book value is equal to how much?
7,200.
7,200. All right. So for the third year, 7,200 times 40%. Same thing, yeah. And you keep going until you get to $2,000. All right. This is the double declining or the declining balance method. Okay. Okay, let's assume that this truck was purchased on. Okay, when did it first originally say it was purchased on which date? It doesn't say, huh? Okay, let's assume it was purchased on June 1st, 2017. Okay, let's assume that it was purchased on June 1st. The truck. truck was purchased on June 17,
That's June 1st.
June 1st, sorry, June 1st, 2017. So, what is the depreciation for 2017? Using a straight line.
Oh, the straight line would be.
Uh-huh. Using a straight line.
So you gonna subtract 20,000 by 3,600.
Now you got to see first, if we use a straight line,
Oh well, we got the cost. Then you gonna subtract the residual value, then the estimated life of the truck.
no, wait a minute. It depreciates for $3,600 a year, correct? So if you divide $3,600 by 12 months, $3,600 divided by 12 months, what do we get?
$300 a month.
300 per
12.
month, correct?
Yes, sir.
So how many months went in 2017?
12.
So we had January. Now
Six
remember it
months.
was, no, sorry, it was purchased on June 1st, correct? So we have June, July, August, September, October, November, and December. 7 months. So the depreciation for that year is 300 times 7 months
2,100.
equal 2,100. Yeah, that's how you should look at it. Yeah. First, depreciation per year, then you divide it by 12 months, all right, times how many months have passed for that specific year. That's a partial year depreciation, okay? If we were to do a journal entry, if we were to do a journal entry for the depreciation in 2017, what do we debit, what do we credit? If we were to do a journal entry for depreciation, what do we debit for 2017?
You debit the
What account? Depreciation,
debited by 2,100, right?
expense. Remember account. You know, first identify the account, not the amount. The account for how much?
2,100.
2,100. And what do we credit?
Wouldn't it be the value? Be the book value of the truck.
Not the book value. What increases? The accumulated depreciation.
Oh,
Yeah, so we credit the accumulated
oh, that'd be the same.
depreciation for
2,100.
2,100. All right. Always depreciation expense associated with accumulated depreciation. Always. All right. So you're gonna do a monthly or a yearly journal entry. Okay. For the depreciation. It's very important to keep that because we got to know what is the carrying value or the book value of the asset. And remember, on the balance sheet, we have to say, if we were to report this truck on the balance sheet, we're going to say truck, $20,000 less what? Less accumulated depreciation from day one it was purchased until that year's balance sheet. All right? Okay. Which one of these three methods you think that will give us a... Which one of these would you use? It depends on the assets that we are using, correct?
Yeah.
Now, for tax purposes, which one do you think that will? Now, remember, we need big depreciation for tax purposes. Depreciation expense, so you pay less taxes. I shouldn't say that here on the record, yeah. But the
That double declining.
double declining,
Yeah.
but that's if you are using the asset, if you are using electronics. But for usage of the truck, I don't know if you are.
Production method.
You know, you might be right about that if you use the production method. Well, is that better for tax purposes?
It still depends on what you're using, right?
If, let's say the truck, for example. Which one is better for tax purposes?
You say you needed to depreciate more, right?
Yes.
So I'll use the double declining method.
No, but see,
So you need to depreciate more, right?
yeah,
Oh, like,
but you don't use the double decline for the truck.
okay.
If you have electronic, see, the IRS may not approve it for you.
Oh, okay.
So we do the production method for the truck.
Either the production or the straight line.
Oh, okay.
So, which one do you think gives you
So-
more?
This for electronics, right? The declining.
And many other things too at the same time. If you can convince who knows, maybe if it's a rental car, if it's a rental equipment, it's used heavily a lot. So possibly you can use also double declining.
Cause I mean, you're not getting it 100% anyway if it's already used, anyway. You know what I'm
Yeah.
saying? So.
I think maybe production method is better.
Yeah.
Production method is better. But the IRS, I don't know, I think they have some accelerated tables. I don't know, they have tables and they go by those tables, yeah. But I don't have them here. Okay, let's assume for this truck, all right, you want to get rid of it on the 4th year. At the end of the 4th year, you want to scrap this truck, get rid of it. What kind of journal entry you would have to do? If you want to get rid of this truck, look at Exhibit 4, and we are using straight line method. All right? So we want to get rid of it at the end of year 4. So what do we debit? What do we credit? Remember, we said whenever you get rid of a truck, you have to do a journal entry. You can't just throw it away. So we're going to debit the original value of the truck. If you look on discarded on the page 380, it gives us, look at the journal entries on the next page, on page 381. Look on page 381. Okay, if you look at the journal entry, they debited accumulated depreciation for $9,300, which is, it looks like this is a different,
It's a different problem.
yeah. What is the book value at that time? So for us, on the truck, the book value is what at the end of year 4?
For the truck, 5,600.
5,600. And so we're going to debit. See, originally accumulated depreciation has a credit balance, so we have to debit it. Yeah.
Really close.
And so we're going to debit depreciation expense for, I'm sorry, accumulated depreciation for $5,600, and we're going to credit the truck at cost, which is 20,000. So in this case, are we losing or we still have some life to go with it? We still have at least $3,600 to go. 36.
To 2,000, right?
We still have to go.
To 2000.
So the difference is going to be a loss because we got rid of it before
They depreciated.
it fully depreciated. Yeah. So we're going to debit accumulated depreciation. At that year, it was at its book value, which is 5,600, and we credit the truck at
20,000.
20,000, and the rest is going to be a loss.
So will we debit the loss?
Yes, sir.
Okay, debit the loss for what? 3,600.
With the difference between the two.
Difference between 20,000
And
5,600.
yes, sir.
600
And
2,000.
5,600, yeah. That's a lot of loss. No, it makes no. Well, because we are just assuming here, but that's what you should do. You debit the accumulated depreciation
So it'll
because we're getting rid of the whole truck.
So it'll be like 14,400.
Mhm.
Okay.
Yeah,
Cool.
we're just assuming here. Okay. Okay. How do we figure out the depletion? If we go back, the same thing like what we mentioned for the straight line method,
Like the same thing.
like straight line. Look on page 384. Page 384, you will see depletion cost per unit is equal to cost minus residual value divided by the so if you have a wood or a forest, especially to cut wood, all right, and that wood has, let's say, a million, or let's say 10 million board feet of wood on it, okay, and on that specific year, okay, let's say we cut maybe 100,000 or 200,000 board feet at that time, and so we will say we're going to get the cost of this, how much we bought it for, minus what we have used, the 250,000 board feet divided by a million board feet, yeah, and that will give us how much it was depleted for that specific year. Okay, you take the original cost. So let's say if we bought that wood, that forest for $10 million, we used 200,000 board feet. So we say 1 million minus 200 board feet divided by the wood on all the wood on it. If we said a million board feet, so you divide by 1 million board feet. Yeah. And that gives you the depletion per unit. Yeah. Okay.
The cost minus residual value divided by the estimated.
It's very similar to straight line method, yeah. And you can look at the example in the book. A mine was purchased for 3,600,000. It has an estimated residual value of 600,000. That's a different example. And it consists and contains an estimated 3 million tons of coal on it. And so you would have to say the original cost is 3,600,000 minus 600,000 divided by 3 million. And that should give you $1 per ton. Okay? Okay, now intangible assets.
Ton?
Huh?
Oh, I was talking about the ton because it said $1 per ton.
Oh, hey, Dr. Johnson. Yes, ma'am. Yeah. So, how about intangible assets? Hey, how you doing? Intangible assets such as copyrights or patent. Okay. Now the copyrights. Let's say somebody, like when I did my thesis, my doctoral thesis, I copyrighted it. Yeah.
No one can steal it.
Huh?
Or no one can use it without having a.
Without,
select-
yeah, but I gave the right to the Library of UNT,
They paid.
University of North Texas.
They paid.
I don't know if somebody used it or did not use it. It's up to the UNT library. Because I gave them that right to take care of the charges. If somebody want to make copies
So
or
then you get a cut from it.
not a penny, yeah.
Oh, come
It
on.
goes to, it goes to the library.
Sleep.
Huh?
I say sleep.
Imagine you don't donate something in your name, have your name up somewhere. To,
Yeah, have a hall or something.
No, but it's customary that PhD candidates
donate their
they
thesis.
leave it in their school library, yeah. So that's
That break me off some
yeah.
bread.
and I don't think that many people are going to pay when somebody takes. Some they do it free. You know, like if you're doing a research and then you are going to just make a copy of a couple of pages, I don't think they're going to charge you for it. Yeah, they let you.
10 cents.
But
a
you know,
page.
but they have to cite me as the author. Yeah,
Oh,
they
yeah,
have
of
to
course.
cite. So copyright. That's what copyright comes by. Yeah,
If
they
don't
have
cite-
to cite my name for it. Yeah.
They don't cite you as plagiarism.
Huh?
They don't cite you as plagiarism.
If you don't cite, yeah, there will be plagiarism. Yeah, definitely. Yeah. So how long the copyright would last? It lasts for the life of the author, plus I don't know how many years, 60 or
70 years.
70 years, yeah, after the author died.
So after them 70 years, they will not be able so the author won't even be able to renew. So after 70 years, then it's up for grabs. Like
Yes.
that's crazy.
Talk. Wait,
Okay.
what?
So like
run that back one more time.
So
You
like
said-
say like his thesis like after like 70 years after he died, his work won't be copyrighted no more. So anybody
Yeah.
can just use it. as-
Oh, I'm about to go steal somebody's ideas now. I'm about to go look for everything in
Yeah.
and above.
After
The
that,
patent, how about the patent? Do they have the
patent?
patent here?
Yeah,
I think it's 30 years, the patent, 18 to 30
20
years.
years.
20 years? Yeah.
To make a particular product or use a specific process, and so I mean, granted-
Just like the medication. If you have a new medicine, it will be patented for 17 years. After that, it
You
becomes
gotta renew it. You gotta
generic.
You gotta renew your patent, don't you?
If you
Well-
don't renew it, it becomes a generic. Anyone can manufacture it, yeah. Like a medicine. Yeah. Anyway, so that's how these, depending on the life of those intangible assets. Yeah. Okay, this is all. That will mark the end of chapter 10, and I don't think we're going to have any more chapters.
So did you hear anything? Did Dr. Jones ever email?
I think you probably he misunderstood you. Maybe he.
No, I asked because first of all, he didn't even want to talk to us. He sent his assistant out to talk to us, which kind of made me mad because he was right in the next room over, telling her to come back to say to us. Anyway, I was like,
No, I think he probably misunderstood.
he didn't misunderstand.
Yes, he did.
He was like, because he told his assistant to tell us, like, well, he said it's too late to add any more classes onto the list. That's what. he
Yeah,
told me.
because that's probably the summer one, maybe.
No, it's-
That's what probably
No, we
understood.
told him
Something
we
too.
said we specifically said something too.
Okay, I would ask him because I mean, this the last week of summer one. Why I asked him to add courses on now? Like I couldn't enroll in no courses.
I've been
That's-
hearing like Christmas
that's
time
kind
too, not even ready to be.
Just wait and see.
No, it's not.
Wait and see. Okay. Yeah,
Start.
keep watching because the registration haven't started yet.
Now, I see some people that register for their classes. Like, well, if you go down the list, it'll tell you how many seats open. All I was looking at, there's already some seats taken in some classes. So people already started registering because you can register online. And the list been out since Monday afternoon, I
Mhm.
believe. So, I mean, registration basically already started for it.
But the
'cause it's-
semester hasn't started yet.
I mean,
Yeah.
I mean, you gotta register before the
Yeah.
semester start Monday. I mean, they're not gonna let people keep enrolling on Monday when the classes start.
Yeah, it will. It will. Let's watch and see.
Yeah,
Let's
it
watch.
will.
Just,
I
Yeah.
got this class.
Oh, yeah,
Mhm.
true.
Let's watch and see
Alright, so you're gonna be teaching Christmas accounting too, though, right?
if it's offered. Yeah.
Okay.
Mhm. Okay, so up to chapter 10 is what we do. We're not going to do anymore, and that's what we do with the regular class.
Okay.
We cover 10 chapters. Sometimes we do 11, but But what we're going to do is some practice now. And we're going to go back. Remember, we were supposed to do bank reconciliation. So we're going to go back to 8, 9.
I think we did bank reconciliation. Like we did examples of that.
Now, we didn't do prayer. We did the example in the book.
Oh yeah.
Yeah, we did the example in the book. Yeah. And so we will do a example for chapter. We start on, I think we'll take it one day at a time for each chapter. And I'm going to give you a chance to do the rest of your assignments. Yeah. And that's to you all, the ones who are online, is your this week. And some days in next week is going to be your last chance. As the email I just sent to everyone, your last chance to catch up with the assignments and the exams. So exam 1 and 2 already open. All the assignments are open. So it's your last chance to catch up with the assignments. I hope you are not giving yourself an F in the class. So if you haven't done nothing, you know what the result is. It's up to you guys. I'm trying to help you. All right? Have a good day.
Might stop the stream. It tell you how many people viewed it?